Hello and welcome to Chapter 5. In Chapter 5, we're going to be covering cost volume profit relationships. I think this is probably one of the most useful tools that you'll learn in this class because it allows you to look at your cost structure, your fixed cost, and your variable cost, and determine how many units you need to break even or to make various level profit. So you can use this either with a service company or a manufacturing company or a merchandising company. So this really will give you an idea of, how many units do I need to break even? What happens if I increase my volume by X percentage? So this is something again that I think is extremely useful. Now there are certain assumptions. First one is that selling price is constant so that as you produce more, you don't sacrifice sales price. Also, the costs are linear and can be accurately divided into variable and fixed components. Now, of course, fixed components are things that aren't easy to change. For a restaurant company, you have the building, you have the tables, you have the cooking equipment, and that will allow you a certain capacity. But within that capacity, those fixed costs aren't going to change. And the same for variable costs across that relevant range. And then if you have multi products, then you have to assume a certain percentage of how many of this product you're going to make and how many of this product you're going to make. And that assumption remains constant. So the first thing we're going to do is calculate the variable expense ratio and the contribution margin ratio. Now, contribution margin is the amount that's left over after paying for your variable cost. So let's say that you're charging $9 for a hamburger and all of the variable costs, the hamburger itself, the bun, the lettuce, the tomato, the cheese, the bacon, and let's say that all of those are going to cost you $4 and you sell it for $10. Then you make $6 of contribution margin for each hamburger that you sell. And so that contribution margin is then used to pay for your fixed cost. So we can come up with a ratio. And in this case, we're going to say that our variable expenses are $120,000 and or I'm sorry, yeah, our variable expenses are $120,000 and our sales are $200,000. And so it's a simple calculation of the variable expenses over the sales, and so that's 60%. So 60% of our sale price is cost. And so that leaves 40% for profit. So our contribution margin percentage is 40% because the $80,000 is what is left over. So that is again 200,000 minus 120,000 in cost leaves the 80,000. And so our contribution margin percentage is 40%. And we can use this for various calculations. So again, contribution margin per unit divided by sales price per unit, or contribution margin total divided by sales price in total. Either way, you're going to come up with the same percentage, which is 40%. Um, Same thing here. So contribution margin, again, is sales minus variable expenses. If you're a car company, you're going to be subtracting the sales price, or you're going to be have the sales price, and from that you're going to subtract your variable cost, which will be all of the components that go into that car, all of the direct labor that goes in that car, because those are variable costs. If you don't make a car, you're not going to need those expenses. You're not going to have any parts, material costs. You're not going to have any direct labor costs, but you still will have the overhead. So we can use this to estimate what our additional profit will be once we hit break-even. So in this case, our break-even is going to be 400 units. And you'll see later on that there are various formulas that we'll be able to use to determine what this number is. But if we go from 400 to 500 units, then really what all we're going to be able to determine what that additional profit is by multiplying the sales increase by the contribution margin percentage. So for the next 50,000 sales, we make 40% of that, or $20,000. So once we reach break even, every additional unit is going to bring in 40 cents on the dollar, which you'll see here in a minute. So if RBC increases sales volume to 500 bikes, what would the management expect the profit to be? 40% times $250,000 minus $80,000 is $20,000 profit. This is the contribution margin ratio times the sales minus the fixed expenses. All right, so that's $100,000. So again, we make 40 cents on the dollar for 250,000 in sales, we end up with a contribution margin of 100,000. Our overhead fixed over costs are 80,000, so that leaves us a profit of 20,000. So let's try a problem here. Coffee Klatch is an espresso stand in a downtown office building. The average selling price of a cup of coffee is $1.49. The average variable expenses per cup is 36 cents. So, sales price of $1.49, and we subtract from that 36 cents. And so that leaves us a contribution margin of $1.13. The average fixed expense per month is $1,300. An average of 2,100 cups are sold each month. What is the CM ratio for Coffee Klatch? Well, the contribution ratio we can look at is our contribution margin per cup is $1.13, and our sales price per cup of coffee is $1.49. So that should leave us with a contribution margin ratio of 0.758 or 75.8%. So you see the markup is pretty significant on a cup of coffee, at least in this example. And again, we've got a 149 minus 36 divided by the sales price. That gives us the contribution margin percentage. Okay, so we want to look at what effects um, this is going to have on us. Now, what I found it easiest to look at is to imagine a jar of marbles. The jar is your fixed cost. So the higher your fixed costs are, the more marbles you'll need to fill that jar. The marbles represent your contribution margin. Again, that's your sales price minus your variable cost. It's your profit for each dollar of sales, or for each sell that you can use to pay for your fixed costs. The larger your contribution margin is, the larger your marble is. So the larger your contribution margins, the less marbles you need to fill this jar. Or the size of the jar. Okay, this is a smaller jar, which represents that we have lower fixed costs. This is a larger jar, so we're going to need more marbles. In addition, in this situation, we have a higher contribution margin. So our sales minus variable cost is higher than in this situation. So you can see that as your fixed cost increase, you need more marbles. But as your contribution margin increases, you need less marbles. So in this case, this contribution margin is higher than this contribution margin. So that means either the sales is higher or the variable costs are lower. So to get larger marbles, basically you either need higher sales price or lower variable cost. And to lower your break even point, you need to either have a higher contribution margin, or you need lower overhead, fixed cost. So I think if you keep that in mind as we go throughout, it might help. All right, so cost volume profit analysis. Again, we've got bike sales of 250, variable expenses 150, contribution margin is 100. We subtract fixed costs, net income of 20,000. We've seen that before. So again, contribution margin is used to first cover fixed expenses, and anything left over is our operating profit. Sales, variable costs, and contribution margin can always be expressed on a per unit basis. And in fact, trying to determine break even, I think it's much easier just on a per unit basis. And so here you've got per unit is $200, right? So we sold 500 bicycles. So the sales price per bike is 500. The variable cost is 300. So we make a profit of $200. Now, if we wanted to determine the break even, all we're really going to need to divide is, all right, we've got to cover $80,000 of fixed cost. How many of these is it going to take to cover that? Well, you just simply divide 80,000 by 200, and that will give you the amount of units you need to break even. And we'll see this later on. So each month, RBC must generate at least 80,000 in total contribution margin to break even. And so we take the sales of 400 bikes, all right, and let's see if they have the formulas here. Again, what this represents is, all right, once we hit break even, the next bike, we're going to get $200 off each bike. So when we hit our break even point of 80,000, which represents 400 bikes, we're going to generate $200 profit for every one of those bikes above this amount. To determine this break even, again, would be 80,000 divided by 200, which is our contribution margin, our marble. Okay. Our jar is 80,000. All right. And simply dividing 80,000 by 200 equals the 400. So if our contribution margin, or if our fixed cost were 100,000 and our contribution margin stayed the same, 200, we would need 500 bikes to break even. And that would be simply $100,000 fixed cost divided by 200 is 500 units. To determine the break even, once you know your contribution margin or your marble size, all right, this is your marble size, and then you need your fixed cost, which is the size of your jar, is pretty simple. We don't need to prepare an income statement to estimate profits. All right, all we do is say, okay, 30 units. If we sell 30 units, that's 30 units above break even. Then our profit should be 6,000, which is 30 units times our contribution margin. All right, so we can normally we look at a different format as far as the income statements, but that's financial accounting. Here again, we're just trying to figure out, all right, what is our operating income at 4/1? And it should be $200. And so the K hold on, let me look at this. Okay, so the equation is sales minus variable expenses minus fixed expenses is equal to your profit. All right. When a company has only one profit, we can further refine this equation as shown in this slide. Sales minus variable expenses minus fixed cost. Okay. So profit is equal to the profit per unit times the quantity, or the sales price per unit times the quantity, minus the variable cost per unit times the quantity, minus the fixed expenses. So this is looking at it from a quantity standpoint. So we sold 401 units. You see that. We record the revenue of 500 minus the variable expenses. Or you could do this is just simply 200 times 401, because using a little algebra, Transposing here, it's just 500 minus 300 times 401, and that minus $80,000. So unit contribution margin is just simply price minus the variable cost. So the profit is the, again, unit sales price minus the variable cost. So this is your marble size times the quantity, okay, minus your jar size, which is your fixed cost, and we get $200. So we're getting the same amount, doing a different way. Now compute the degree of operating leverage at a particular level of sales. Explain how it can be used to predict changes in net operating income. So the degree of operating leverage is the contribution margin divided by the net operating income. And it's a measure of how sensitive net operating income is to percentage changes in sales. So the bottom line is that the higher your contribution margin percentage, the more it's going to be, the higher the degree of operating leverage. All right. So if you have, for instance, I used to be in the MRI business, and you may charge $1,000 for a scan, but your variable expenses were fairly low. So you might make, $900 per scan. So $900 out of that $1,000 would be the contribution margin of 90%. But your fixed costs were incredibly high. You're looking at a $2.5 million machine. So you've got to pay a lot of fixed costs. But then every scan, once you hit break even, was $900. So if you just did one scan per day and you have 254 business days per year, each additional scan would earn you a profit of $228,000 per year. So that's high operating leverage. Lower would be, I make $20. So I've gotta have a lot of those to make contribution. So if you're selling something for $100 and and it's $80, so you're making 20 out of 80, so that's 20%. So that takes a lot of those. So your degree of operating leverage is much smaller. All right. In this case, it's the opposite of the $100,000 divided by $20,000, which is your profit. In my other example, $1,000 divided by $900 for the scan, that would be 9. So that's a pretty high ratio. So with an operating leverage of 5, if they increase their sales by 10, net operating income would increase by 50%. And so we increased it by 50. Our profit at 500 was 20,000. Our profit at 550 is 30,000. So that's a $10,000 increase, which is a 50% increase, which is $10,000, which is half of $20,000. So, coffee klatch is an espresso stand in downtown. The average selling price is $149, and the average variable expense for the cup is 36 cents. The average fixed expense is 1,300. An average of 2,100 cups were sold each month. What is the operating leverage? So we are looking at 1.49 minus 0.36 is 113. So 1.49 divided by 1.13 is equal to, well, 2.21. How did they do this? Okay, so they did it the longhand. Contribution margin, net operating income. Yeah, I didn't take into account the fixed cost. So really, it would be the sales, which is just 1.49 times 2,100, less variable expenses of 0.36 times 2,100. That gives you the contribution margin, less your $1,300 fixed cost, is your operating income of 1,073. So your contribution margin divided by your net operating income equals 2.21. The average selling price is 149. Same. So if we increased sales by 20%, how much should net operating income increase? So that should be 2.21 times 20%, should be 44.2%. So our increase was 20%. Our operating leverage was 2.21. So yes, that should be a percentage increase in profit. So you can see that that's a pretty high amount, and that's a good amount of increasing profit once you hit that break even. And this is just sort of verifies that by going through and seeing that at 2520 cups, our net operating income would be 1548. So the change in sales of 20% results in a change of operating income, net operating income of 44. Calculating the break-even point. Now there are lots of formulas here to do this. I again find that the easiest way to do this is through the per unit basis. All right. So let's go here. So equation is the unit contribution margin times quantity minus fixed expenses. So here we have 200 times the quantity minus fixed expenses. So 200 times Q minus fixed expenses. And really, ends up being the same formula. And what it comes down to is fixed cost, jar size, minus divided by contribution margin, 200. So you need 400 units to make 80,000. And that just makes sense. For each unit, you're making $200. So 400 times 200 is equal to 80,000. So fixed expenses divided by unit contribution margin is 400 units. That to me is the simplest way to determine that. And then you have the ratio. So 40% times sales. So basically you divide 8% by 40% and you get this $200 in sales. And then you would divide 200,000 by the sales per unit, which is 500. And so you come up with the same 4,400 number. All right. So what is the break even sales dollars? All right. So first we're going to find out the overhead is $1,300. Our contribution margin is 149 minus 36. Okay. So that's 1.49 minus 0.36 is equal 1.13. All right. So 1,300 divided by 1.13. And so that's 1,150 units, and that's times 1.49 is equal to 1,715 if we round up. Okay. And so what we did is we found out our marble size, which is 1.13, and we divided, this is our fixed cost, and we came up with the 1.75. You could also do the margin. Remember, we came up with this for the contribution margin ratio. And in units, of course, we came up with, I believe, 1,150, which is just the number of cups. And then the margin of safety is equal to total sales minus break even sales. Okay. If we assume that RBC has actual sales of 250, given that we already determined the break even sales to be 200, the margin of safety is $50,000, which is just the difference in the sales at break even versus the average. Okay. And so that is really just 50,000 divided by the increase, and that's 20% of sales, which is 100 bikes. Okay. What is the margin of safety expressed in cups here? So we've got 950. This is our break even in cups. This is what we actually sold. So our margin of safety is 950. And then to determine this amount, we just really need to know the unit sales, and then we multiply that by the cost, okay? So unit contribution margin times Q minus fixed expenses. All right, so unit contribution margin. So profit is $100,000. So we want to target profit of $100,000. All right. So that really is like adding $100,000 to your overhead. And before we went, well, we want to know break even point. So break even point is just simply our fixed cost divided by the unit cost or the unit contribution margin. Well, here we just add the amount of profit that we want. So really, what we're looking at is $180,000 divided by 200, which equals 90 units. All right. And really, the formula should be desired profit plus fixed cost divided by the contribution margin per unit, which is right here. And then to obtain the sales, we just multiply that amount, 900 units, times the sales price of $500. That gives us the 180, $450,000 in sales. Use a formula to determine how many cups of coffees would have to be sold to attain a target profit of 2,500. All right. So again, we're looking at 3,800, which is the um, target profit of 2,500 plus our overhead of 1,300. We divide that by our contribution margin, and that gives us 3,363 cups. And then we multiply that by our 149 for the cups, and that's when we get, and that gives us $5,013. And then you can just look at what is the profit if RBC can increase unit sales by from 400 to 540 by increasing the monthly advertising budget by 110,000. So then we're going, well, 40 times 200 really um, is $20,000, but net operating income decreased by 2,000 because what we had is 40 units times 200 is equal to $8,000. So that was our additional contribution margin. Our additional sales, of course, would be 40 units times 500. All right. So you can see that the sales went up 20,000, but because we added $10,000 in cost, that reduced our profit. So that's another way that you can look at these. All right, so that's about all we have time for in this. There's some other things you can look at, but I think we've covered the major concepts here. As I said, this is really a um, a really good tool that you can use in no matter what your business. So I didn't cover everything, but I covered everything that should get you through this chapter and should give you enough information to do all of the homework problems.